Welcome, welcome, welcome. As we get into the end of the year here, or close to the end of the year, coming up on the fourth quarter, one thing that becomes very important, tax saving tips. So I just wanted to do a quick video here. We'll go through 5 tips that can save you some money, but be aware that most of these tips have to be done by the end of this year. So that's why I want to get this out there. I want to get everybody in front of it, and we can try to save you some money. So keep in mind with all of these tips, beware of AMT, alternative minimum tax effects. You'll see there that the threshold for alternative minimum tax is relatively high. So if you are over that threshold, it's something to pay attention to. If you're not, don't worry about it. If you think it might be helpful, leave comments below if you think it's helpful to do a video on AMT. It would probably be a little bit of a bare and pretty technical video, but I'd be more than happy to do it. Disclaimer, as always, I'm not a licensed professional. This video is for entertainment purposes only, blah, blah, blah. Let's get into some tax saving tips. Number 5, sell stocks with losses. We all hate when our stocks go down, but it could work to our advantage to an extent. You are allowed to take up to $3,000 of net capital losses per year. So if you sell $5,000 worth of losses, you would have a $2,000 carryover to the next year. This also is net, so if you had $5,000 of losses and $3,000 of gains, you would have a $2,000 net capital loss. Keep in mind, this has to be stocks sold within for 2017 tax filing, which will be done next year. These are stock sales in 2017, so make sure you get those stocks sold if you're going to go this route by the end of the year. Also be aware, if you're planning on buying back a stock after you sell it, be aware of wash sale rules. Essentially what this is a loss can be disallowed if within the period beginning 30 days before the date of the sale and ending 30 days after the date of the sale, you acquire substantially identical stocks or securities. Essentially what that means is if you buy back the stock, it doesn't have to be the exact same number of shares and all. You could still have a wash sale if you sold 30 and you bought back 40. It's more so focuses on what security you're buying. So if you sold Apple at a loss and then bought it right back, you could run into a situation where your loss is not allowed. Now, I mean, essentially, you're not completely losing out. You would just, your basis, the loss that you would have taken would add to your basis on the buyback. So it's essentially as if you never sold it. What the government was trying to get around here, what the IRS is trying to get around, is people selling stocks at year end, buying them back, first trading day of the next year, just to take their losses. So keep that in mind. Also, beware of missing out on dividends. If you do own dividend stocks, especially around year end, you might run into some X dates or record dates around year end. So if you sell before then, keep in mind that you might not be getting dividends. And then again, if you have to wait 30 days to make sure you don't run into the wash sale, then you might be missing out in some situations on the next dividend. So really pay attention to that if you're owning dividend stocks. And then at the end of the day, also be aware of trading commissions. If you're going to be selling and buying back a stock, I'm through Scottrade for my personal account, and it's $6.95 per trade. So if I sell, that's $6.95, then I'm going to buy it back. That's another $6.95. So those can add up over time if you're buying and selling too much. Number 4, prepaying your real estate taxes. This is something personally I do. It really has a benefit kind of the first time you do it because you're likely to have paid real estate taxes in February or March timeframe, and then your bill will typically come in. Mine comes in around December. So in the first year that I doubled, essentially, I had paid my bill in March, and then when I got the next year's bill in December that would be due in the following March, I went ahead and paid that in December. So we are cash basis taxpayers, so therefore we get deductions in the year that we pay. So for that year, I got a double, in essence, real estate tax deduction. Now the downside is the next year, say you don't prepay for the following year, you're not going to have any real estate tax deduction. Or if you want to prepay, then you're going to just have one real estate tax deduction. So it's something to kind of do as a tax planning thing, deciding if you think your income is going to be higher next year, maybe you want to double pay or pay your normal and then prepay next year. You can kind of tax plan that a little bit. And again, we are tax basis cash payers, so in most cases, charitable contributions, as you'll see coming up, we do make when we make donations, we make payments for expenses. It is deductible in the year that we pay because we are cash basis taxpayers. So again, number 3, charitable contributions. And the other thing to keep in mind with real estate taxes and charitable contributions, these go on Schedule A. If you're not familiar with Schedule A is itemized deduction. So you're either entitled to a standard deduction or itemized deductions, whichever is higher. If you take the standard deduction, then these tips, it could still be good to donate to charity, especially, I can't say dividends for hope because we're not incorporated yet, but it can still be good, obviously, to donate to charity, but you're not going to be getting the benefit if you are using a standard deduction because you won't be filing Schedule A. So that's something to take a look at. Take a look at the page 2 of your 1040. You'll see it'll say standard deduction or itemized deduction, greater of, and you can see what number's in there. So if you are filing Schedule A, then these can come into play. If you're taking the standard deduction, then obviously these won't have an effect. But most people, especially the older you get, especially if you have a house, you're paying real estate taxes, maybe you're paying mortgage interest, you're probably using Schedule A. If you're younger and you don't have those things, or you're older and you don't have those things, you're probably using the standard deduction, but something to pay attention to. What we got here? So similar to real estate taxes, deduction in the year of the donation. You can donate multiple things. You can donate cash, you can donate clothes, household items. Make sure you get a receipt for record keeping purposes, but just know that you do have, it doesn't just have to be cash donations. You can donate physical items. Generally, there's a limit of 50% of AGI, which is line 37 of your 1040, essentially the last line of page 1 and also the first line of page 2. So that tends to be a pretty high number. Most people don't donate that high, but keep that in mind that there is that limitation. You don't lose, if you were to donate more than 50% of the AGI, you don't lose that donation. It's just similar to your capital losses. It gets carried forward to next year. And you get to help others and have a happy holiday season. Help others have a happy holiday season. So there's certainly nothing wrong with that. Number 2, accelerating traditional 401k and IRA contributions. Now, keep in mind that I'm saying here traditional IRA. Most 401ks are traditional. There are options for Roth 401ks. I happen to have a Roth 401k. And then there's obviously Roth IRAs. So in terms of tax savings, we are talking strictly traditional IRAs. So traditional IRAs can be made up until tax day of the next year. This is one of those situations that even though we're cash basis taxpayers, the contribution does not have to be made in the year in the year that we're filing for. It can be made up until tax day of the next year. So again, you can also use that as a tax planning thing just to see. You can kind of plug in, okay, if I contribute $3,000, $5,000, what kind of tax savings am I going to get, and is that something I want to do? Again, you can also, when I say accelerate, if you've contributed, say, to a 401k, you contributed $15,000 through the November, and you have some extra money saved up, and you want to contribute. You can do up to $18,000 if you're under 50. So maybe you want to donate or you want to contribute 70-80% of your paycheck in that last pay period. That's one way to get more contributions into your 401k, reduce your taxable income. Keep in mind that you don't want to. There are restrictions, as you see in that last point. There are restrictions on withdrawals, so it is good to save some taxes now, but make sure you don't get yourself in a situation where you've over-contributed and now you're strapped for money and you have to go take withdrawals from 401k or an IRA, because most situations you're going to pay a penalty for that. And finally, getting married, having a baby. So as long as you're legally married by the end of the day on December 31st, you can file married filing jointly for the entire year. Benefit of that is you get higher income tax limits per tax bracket. So essentially, you and your spouse are paying a lower tax rate than you would have filing single, each of you filing single. Same thing with a baby. As long as the baby's born by the end of the day on December 31st, you can claim that child as a dependent. You may also be eligible for child tax credits depending on your income level. It does take some planning to have a baby by the end of the year. I'm fully aware of that. But this also applies to adoption. I understand that's also can be a slow process. But just know that in terms of getting married, having a baby, all this is as of 12/31. So, as long as you're married or as long as the baby's born before the end of the year, you are entitled to claim, to file married filing joint or claim the child as a dependent, if it is a dependent, for the full year, which is a great benefit. So again, just some quick tax saving tips. Let me know if there's anything else you want me to elaborate on. I'll be more than happy to. Anything I left out, again, more than happy to do another video and dig into them more. Always looking to save money on taxes, but it does take a little bit of planning. Don't forget about it, and then January rolls around and you're screwed. And really make sure you're proactive with your tax saving tips. Again, stay tuned. More videos to come. Appreciate all the support for Dividends for Hope. We're doing amazing. Look out for more videos on that end. There will be some very shortly. We have more great news. So again, stay tuned and appreciate the support.